What's up, everybody? This is Adam Walz with Buy the Ugly House. If you would like to buy an ugly house, but think you can't, listen up. This is the episode for you. So, for today's episode, we are here with Amber Keeton, my favorite lender in the whole wide world, with Highlands Mortgage. And we're going to speak to the first time buyers today. We're going to speak to the aspiring buyers.
Absolutely. Thank you so much for having me, Adam. It's a pleasure to be here. I'm excited.
Yeah, thank you. Thank you for being here. I know you're having a stressful week, so let's talk about it. No, this isn't a therapy session, but hopefully we can kind of help educate people on, what to do and what not to do.
Yes.
Obviously, this show is called Buy the Ugly House. We're trying to teach, maybe beginner buyers how to get into home ownership. And that's really what I want to pick your brain about today.
Yeah. No, I'm absolutely open to talking about it. I mean, honestly, I think a lot of people get really excited in the process. And, that is the first step to home ownership dreams, right? The moment that you can envision yourself taking that big step, it's like it's go time. But if you have your ducks in a row, then you're able to go under contract with a clear conscious of mind. And I think that that's really like the biggest first step is just talking to somebody that can really give you like a full overview of what you have going on, maybe a few things that need to get tweaked, and then, what your strong assets are and makes you eligible to have a great negotiation.
Yeah. Yeah. I
Yeah.
think that's so important. Like, it when you're dealing with a first time home buyer,
Mhm.
as an agent, right? You talk to somebody, the first step sometimes is getting them hyped up enough to believe that, they really can make
Yeah.
a purchase. Cause there's a lot of people out there who, just feel like homeownership is
Scary,
unachievable.
right? Or it's too scary and maybe I'm not ready, but at the end of the day it's really close to a lot of rental prices nowadays.
Yes.
Yeah.
But, there's a balance, right? Because, making that decision, like, yes, I want to
Mhm.
become a homeowner doesn't mean that you're ready right now.
Right.
What it means is like, okay, cool. I can see a path forward.
Mhm.
Now let's figure out all of these different things
Right.
and get into a position where it really does make sense, because your first home purchase can either make or break you financially
Oh, absolutely.
long term, right?
Yeah.
We're talking about like this is going to have a butterfly effect for decades to come.
Yeah.
So you have to set yourself up for success. And if you do it right, it's the best decision you're ever going to make.
Well, and the best experience that you can walk into too. I mean, and getting excited really is the best part. It's fun. But then you want to know that when you are under contract and you're finally making that decision going, "You know what? I feel ready. I feel responsible. I've seen all the numbers in front of me and I know that I can make those payments." You don't want to go into a contract and then have a bunch of loose ends and have it be rocky.
Yes.
So, I mean,
Let's get
honest,
excited and then let's,
let's plan.
curb our enthusiasm and yes, make that
Yeah.
plan. Don't rush.
Yeah, don't rush because you know what? The perfect house is going to be there at the right time. So I would say like my best advice for first time home buyers is obviously, getting in touch with an agent that you trust, having somebody with contacts. But I would also say at the same time, go and get in touch with a lender
Yes.
because you can plan both things out at once, but you have to make sure that the finances are ready to go. And when we talk about, planning it out with a lender, really the basics are taking a great overview of your credit report, looking at any potential past derogatory remarks. Most people have them. Young home buyers are not taught financial basics in school.
Right.
And so becoming an adult and entering the world, it's fun to go buy a new car. It's fun to buy a really fancy car that makes you feel, elite. And although that may be a good move for you, it really just kind of depends on what your monthly budget looks like and what that monthly payment looks like, you know. But taking a good review of that credit report and making sure that there are no loose ends, there's nothing hidden in the dark that we don't know about, and then taking a good income calculation. Providing basic pay stubs, minimum of 30 days, taking a look at your past 2-year history and making sure that we are hitting certain income marks to where our income calculation is not overestimated. And, potentially maybe at the end of the day, your income might vary a little bit. So having that calculation be done correctly and efficiently, I would say that that's probably the biggest hangup I see is when there's moments of rush. Every now and again, those income histories can come back if we're rushing too quickly and your income might change on paper.
Yeah.
So And a good income overview, make sure that you're filing your taxes. Not all loan programs require tax returns to be filed to the IRS. But I mean, if you are looking at an FHA loan, it is a government backed loan. They do want to know that you are claiming your income to the IRS and either receiving a refund at the end of every year or, paying your dues and, playing it by the book.
This is a really important point for my self-employed friends out there, such as myself, right?
Yes. Yes.
I mean, how many self-employed individuals have we talked to that make great money and they're doing really well, and by every metric they can afford a house, but the IRS doesn't
According to
know
the
that.
government.
Right? Yeah, it's such a fine line, like it's like, man, I hate paying taxes, I hate giving my money to the government.
Yeah.
But if you're not reporting that income, it doesn't count.
And that is very true. And that's for, the traditional loan programs, conventional and FHA, and for self-employment, we do go off of what you filed to the IRS as your net profits, not what you made and then your
Right.
deductions don't matter.
Right.
Oh, no, it's what you made minus the deductions and then what is your net profit. Now, the other important information to know there for self-employed buyers is, how long has your LLC been open for? Because if it's only been open 1 or 2 years, and let's say that you knocked it out of the park your first couple of years of being self-employed and you're on a gravy train and everything is moving in the right direction for your future, just keep in mind we have to do a 2-year evaluation on any LLC that has not been open for 5 years and reported 5 years of taxes. So, there's a little bit of rules there, but I mean, worst case scenario, if you do ever have a self-employed buyer who's looking at purchasing their first home, and let's say that they're responsible enough to even have a down payment saved up, there are other options. We've got a bank statement loan instead of claiming all of your net profits to the IRS, which a lot of people like to avoid and for good reason. We can actually take 12 months worth of your bank statements and we can do an income calculation off of the business income minus the business expenses that we can see in cash flow.
So, and correct me if I'm wrong, but the caveat there is that you need to have really, really good credit to qualify for that.
You do have to have higher credit. I would say, higher credit means you might have a little bit more wiggle room in your down payment, but I would say minimum of like a 675. Now, your
Okay.
interest rate gets impacted with a credit score in that 675 range. If you're looking at like cream of the crop interest rate with, a decent basic down payment for bank statement, which is anywhere from 15 to 20% down, then I would say your credit probably needs to be above a 760 or higher.
Got it. Okay.
Yeah.
So, as with anything else, your credit score is going to benefit you. The better your credit is, the better. Generally speaking.
Yes.
But I do want to speak, I kind of want to get back to like your average everyday first time buyer.
Yeah.
Because it is the case that like you don't need great credit to buy a house.
You don't, no. And, that being said, honestly, where most buyers and most consumers do have a credit report passed, right? There's a good chance that maybe something on there has negatively impacted your credit. And a mortgage loan, adding that to your credit portfolio and making your monthly payments on time, it's going to help improve your credit score dramatically. So if you do find yourself in that boat and you know that you can make monthly payments on a mortgage for a certain price range, but maybe your credit isn't as ideal as you think it should be, don't be afraid to add that to your credit report, because as long as you make your payments, it's going to help your credit report in the long run.
Absolutely.
Yeah.
What would you say is like, let's say the bare minimum requirements, right?
Yeah.
For somebody to go in, they've made the decision, hey, I want to own a home.
Mhm.
I feel like everyone would like to own a house, but they've made the decision, like, yes, I'm gonna do this.
Mhm.
And maybe their credit isn't perfect. Maybe, they've had some late payments or, whatever the case may be. We need to take them from like where they're at to a position where not only can they buy a house, but it's a good idea.
Yeah.
What would you say, in your opinion, as a lender, what's the bare minimum requirements?
Well, bare minimum requirements, if we're talking about like an FHA loan, credit score has to be a 580 or higher. Okay.
So, and 580, right? I mean,
that's a lot of grace and a lot of leeway for a lot of people in their credit history. Now, that being said, if I'm talking about, financially, what would I like to see you get to a certain bar that would benefit you on a cost or a financial basis. If you can bring your credit score, your FICO score, up to a 620 or higher, at that point, you're going to save yourself additional fees and closing costs. Because although the bare minimum requirement is the 580, you may end up with an extra 1% in closing cost fees depending on which loan program that you go on to. And although we can kind of, wrap those fees into a loan of some sorts, again, depending on the loan program that you're looking at, you may not have to pay it out in cash, but at the end of the day, are you about ready to finance in anywhere from $2,000 to $4,000? But you may not have to.
Sure.
Yeah.
So kind of taking your personal situation into account. And that's what I
Yeah.
tell people is like, only you can decide where you're at in your life and
Mhm.
like what needs to happen. But let's say somebody's in a situation where they have to move anyway,
Yeah.
right? And they've only got a 580 and it's like, whatever circumstances, like, yes, I need to get something done right now.
Yeah.
It is possible. If it's not a rush, maybe it makes sense to spend a few months working with
Oh, yeah.
you and I, right? Both of us have
Yeah.
helped a lot of people improve their credit. Maybe let's hold off for a few months.
Yeah.
Let's get a few things done. Let's give you, a few to-dos,
Mhm.
get you up to that 620.
And save you cost and then give you the green light. Absolutely. But
Because it's usually not like a rush, right? Like it's usually not like, hey, if I don't buy a house right now, the world's gonna end.
yeah, it's usually not. I feel
We
like
get
sometimes
excited, but it's like, usually we can afford to
to wait a little bit. Yeah.
make a few calculated decisions and
Yeah.
plan ahead a little bit.
Yeah. And for the buyers that are in a situation where they do have no other option but to potentially sign another year's lease or purchase a home as soon as possible with whatever they can afford at that time. At the end of that day, what goes through my mind is, well, is it worth it for you to spend another year on rent payments that don't benefit you whatsoever?
Yes.
Or is it worth it for you to finance in that extra 1% in a closing cost fee? And I feel like it's hands down buy the home.
Yep.
Yeah.
Perfect example.
Yeah.
Yeah. I just closed a deal with the gal that was her exact situation. She's rented this house for I think like 4 or 5 years.
Okay.
And then suddenly the owner out of nowhere decides to sell it out from under her.
Oh no.
And she's on a month to month lease. So they're
Yeah.
allowed to do that. All they have to give her is 30 days notice.
Okay.
And, so that was kind of the thought process. She called me in
Yeah.
tears, like, hey, like, this is my situation. What do we do?
Yeah.
And it's like, okay, you can find another rental, sign a
Mhm.
year lease, like you said,
Yeah.
and spend another 12 months on what I call 100% interest, just dumping money into
Oh, it
somebody else's
absolutely is.
pocket.
Yeah.
Or we can figure out how to buy you something right now.
Mhm.
Right.
Yeah.
That's a situation where if you do the math, it saves money to
Oh, yeah.
act quickly and to
Yeah.
make that purchase now.
Not only does it save money, but it's also taking that next step and going, you know what? This is me showing financial responsibility.
Yeah.
I am from now on going to be working on my financial portfolio and my financial future. And honestly, the goal is maybe not even one new home, in your lifetime. Maybe at that point, you've got a dream of turning your first home into an investment.
Yeah. And
Maybe
the
you'll,
sooner you buy that first house, yeah.
yeah,
I mean, the compound effects of equity growth minus or plus, principal pay down,
yep,
right? You're building wealth. But then let's take the opposite of that. Let's say somebody, just signed a month to month,
hmm,
whatever. They've been in their apartment for a year.
okay,
They just got put month to month, and there's the landlord has no intention of evicting them anytime soon.
sure,
And they're sitting at like a 590 credit score, and they've got some credit card
yeah,
debt and a few things. Does it make sense to push that buyer into a purchase right now? Or should we say, hey, there's no rush. We can save you, thousands of dollars
yep,
by just delaying this purchase by 90 days,
yeah.
getting some debt paid off.
And it's not always 90 days, just depending on what you have tied to the credit, right? If it's let's just say that, you're in your young 20s, you're a first-time home buyer. You might have 2 to 3 credit cards and a car loan, okay? Well, the car is a necessity. You probably need that to get to and from your job. But how do those credit cards look? Are they close to being maxed out on their balance? Because I mean, I know at least personally, I've gotten in that situation multiple times in my, adulthood, and every now and again we need those credit lines.
Yep.
So when they do get maxed out, your credit score comes down because of your credit risk. right?
Yes.
You're maxing out your credit card. You have no additional wiggle room.
The bureaus call it your utilization
There
rate.
you go. Yeah, that was the word that I was
You're
looking
using
for.
a high percentage of your available credit,
Yeah.
which looks irresponsible.
Right. Or, looks like you're having a harder time paying back the debts that you've agreed upon, right?
Yes.
Because at the end of the day, you're still spending the money, but where it's on a credit line, it's not really your money. So
Yeah.
you do owe it back, and you owe it back with interest. And every now and again, the interest gets so high that it's even just hard to make those minimum monthly payments.
Yeah.
And so when I do have a buyer that's in that situation, um, a lot of times the month to month rent may come at a higher cost. And at that point, I think it kind of gets their gears going of, why am I paying this amount of money when I can go buy a home? And it's like, you're right. But let's take a look at everything. How much do you have
Yes.
in savings? Do you have a family member or friend that might be able to spot you a few $1,000s to help improve, your current situation? If that's the case, if we only are talking about a couple of different trade lines and you do have the cash to pay them down, at that point we can do something called like a rapid rescore. So,
Yes. Rapid rescore is one of
yes.
our best friends.
Yep. And what we do is we collect the statement for that trade line after you have paid the balance down. Now, it doesn't always have to be paid down to a zero balance, but I do have a tool in the background that, after we take a credit report poll, I can go ahead and start playing with the numbers. And depending on how low we pay those trade lines down, your score has a better chance to increase to a certain level within an immediate response, or within 30 days, or anywhere from, 90 days to a year out. So we can even create like a roadmap for a lot of these buyers based on their time frame and what's best for their family. But I would say 90 days is a good ballpark for like a natural increase in your credit, which again shows a lot of strength. You're going to go through 3 months within those 90 days of on-time payments, positive payments, and lower balances on those credit utilization. So it's going to have a great positive impact for them, and showing that month after month, it will compound into a higher score.
Yeah.
But if you have the cash and maybe you don't need to use it for a full down payment, maybe it's better to free up your monthly cash flow and, let's get those statements submitted to the bureaus. Let's increase your score immediately, and let's see if we can hit those goal marks,
Yeah.
right?
And that's one of the best. Like, I love this
Yeah.
tactic because it really can just shoot somebody's score up overnight.
Oh yeah.
This is a method that I myself used recently, right? In the
Mhm.
middle of trying to buy an investment property. And
Okay.
it's like, okay, I've got some credit card debt over here.
Yeah.
Right. Right now, this is my credit score. Literally, pay off a few grand in credit card debt, and it
Yeah.
like just shoots up through the roof.
Right.
And suddenly you've got better terms.
Well, and like every now and again too, we do have buyers that they've been saving and they have, a decent amount in their savings account. They may still have those credit cards tied to their credit report, but their intention with that savings was their down payment on their home.
Sure.
But I like to kind of give all options, right?
Yes.
Because if I really take a look at what programs we have here in the state of Idaho, we do have multiple assistance programs, both for conventional and for FHA, to where you don't have to have a full 3 to 3.5% down payment for your first home. Instead, you can wrap up about, 3% on average for an
All but
FHA.
$500.
Yeah,
Right?
all but $500. So everything but the $500 minimum goes on a second loan. Typically, I would say that second loan balance is going to float around $8,000 to maybe $12,000.
And then what's
Okay,
the monthly payment going to be on that?
like $120 max.
So for an extra $120 a month,
Yeah,
you can save yourself $8,000 of a down payment.
exactly.
And a lot of the people that I work with could never even, in this stage of their
Yeah,
lives, they've never even dreamed of saving up $8,000.
right,
And that's one of the reasons they believe that they can't buy a house,
right.
because it's like, like by the time you pay your bills, rent,
Mhm.
your car payment, you've got some credit card debts, and you also have to eat, right?
Yeah,
And you also have to buy clothes and have fun. The idea of saving up $8,000
hmm,
anytime in the next decade, right? It's just not feasible.
right.
And so the fact this program exists is so encouraging,
It's
because it is possible to buy a house
yeah.
for less than a security deposit on an apartment.
Yeah, no, that's a fantastic point right there. And like going back to the buyers that do have a bit of a savings and they choose to forego the down payment in exchange to pay off the consumer debt. I mean, if we look at an average maxed out credit card of consumer debt that averages close to that $10,000 mark, you're paying anywhere from 200 to, I mean, maybe even closer to $400 by the time that you have a 23% interest on that credit card and your minimum monthly payments and we're maxed out. And, and that right there is a huge chunk of that monthly cash flow that they struggle to eliminate in order to start building that savings. Well, if we look at the cost of a second loan for the assistance program, if you're going to trade anywhere from $200 to $400 in a credit card payment for $100 on an assistance loan, I mean, that just frees up $300 for
Right.
you.
Yeah. And then look at
Yeah.
the math to the underlying interest rate,
Yeah.
goes from like 25, 30% down to what, 8?
Yeah, 7%. I think right now it's like 7.75 for, the basic FHA with assistance. But I mean, if you're a first-time home buyer who's filed their
And that's just
taxes,
on the second loan for
yeah,
the record. The second loan is going to be about 2 points higher than your first. So
right.
if you're getting a 5.5%
Yeah.
interest rate on your primary mortgage, then your assistance loan is going to be at 7.5%.
Yes.
Right?
Yep.
Roughly.
Yeah. I would say in a nutshell, the base FHA with assistance program is available for first-time home buyers and not first-time home buyers. Somebody who has owned a home in the past, but maybe their income bracket still fits this program mold. And so I would say 5.75% is where we're sitting in today's current range. Okay.
Yeah.
Now, if you are a first-time home buyer right now in this time of year, this state program does have a bond program available that buyers can choose to apply for, and instead of that 5.7, we're currently looking at like a 5.375.
Oh, nice.
Which is awesome.
That's pretty good.
And
Yeah.
then the second loan would be 2% higher. So second loan with like a $10,000 on average balance, we're looking at a 7.375. So yeah,
Sweet.
very affordable. It's really not bad, and I think it's a lot more achievable than most people make it out to be. But I mean, at the end of the day, it's worth having a conversation for, doing a soft pull on your credit, getting a base idea before going, okay, I think I'm ready to do it.
Awesome. Yeah.
Yeah.
I think that's kind of the moral of the story
Yeah.
is, yes, it's possible. I truly believe that everyone can buy a house,
Yeah.
eventually, whether it's right now. And there's so many people that literally like right now would be the best time for them
Right.
to buy, and they just don't know it.
Right.
And they truly believe that it's not something that's possible for them.
Mhm.
And those are the people that I'm trying to reach.
And we're trying to break through too. Absolutely.
Yeah. It's
Yeah.
good for the world when more people own their own homes.
It
It's
is.
good for the community. It's good for
Absolutely.
society at large. Like I want as many young people out there to start building wealth in real estate as possible.
Yeah.
Um,
Well, and start helping themselves, because I mean, at the end of the day, we're all fighting for a better future. We're all doing everything that we possibly can every single day of our lives, but wouldn't it be nice to still pay roughly about the same amount in your monthly bills and know that you're still benefiting your future and you don't even have to pay attention to the equity growth?
yeah.
It just happens over time. As long as you make those payments and you show responsibility, then, anywhere from 2 to 4 years down the line, you can tap into a decent amount of equity and either take that and use it for your next down payment and upgrade your lives, or potentially refinance your home, use those costs for the refinance costs, and have a lower interest rate, pay off some of your monthly debts again 5 years down the line, and just kind of work towards making your everyday life better.
Yeah. I just
Yeah.
can't stop nodding right now because you're just preaching. You're
Ah,
preaching truth. This is amazing. Like, and yeah, so cut,
yeah.
make the decision, come to the
Yeah.
realization that you can buy a house.
Yeah.
And then sit down and make a game plan.
Right.
Right. And figure out, maybe you'll be surprised, and maybe right now is the best time.
Right.
And if not, you've got a few steps, and
Yeah.
you're making forward progress.
We're making a plan, right? We're building a relationship with people that hopefully are working for you too. Because at the end of the day, the professionals that you hire in this industry, they are here to help you. We're here to work for you. And so, picking a realtor that shows you all options, gets you in contact with the best people that you need to know in order to make a right decision, right? And then, talking with a lender that, sure, I might be able to get you a pre-approved for the loan that you originally suggested, but after taking a look at your entire financial portfolio, maybe we need to redirect some funds because it's going to make your monthly budgets a few $100s cheaper.
Yeah.
I mean, that's it. A few $100s for a family is huge every single month.
Yes.
That's your grocery bill,
Yep.
So it is. It's good to just take that first step, but take it patiently.
Yes. And I do want to say that, for people listening right now, if you want an agent to speak with who is not going to pressure or rush you into anything, I want to help you. I want to have a conversation, right? Because if it's not the right time, not only am I going to tell you that,
Yeah.
but I'm also going to help you make a plan, right? To get to where it is the right time. So don't feel like, calling me, you're wasting my time if you think that you're not ready. Because even if you're not, right, like we'll get you there.
We'll get you there. And you know what? I will say too, Adam, like you are probably one of the agents that I know in this town that follow through with their clients. So even if the game plan is, a few months down the road, you keep in touch with them. You remind them, you help them. If they have judgments or collections that maybe they need to clear up, you hop on the phone with them and you help them through the process
We've
as needed.
negotiated down a lot of debt for people.
Yeah. So I would say that you're a huge asset. And call Adam Walz if you do need a game plan.
Well, thank you.
Yeah,
and
you're
chances are when you do that, I'm going to put you in touch with Amber Keeton for
I appreciate that.
So,
all right, Adam. Now, I did come here with a plan, okay? I want to
Okay.
test how fluently you can understand the government mumbo jumbo that we use in our everyday lingo in this industry.
Great. Okay.
Okay, you ready?
Yeah, I'm ready.
All right. Okay. What is LTV?
LTV? Loan to value.
There you go.
Yeah.
Can you give a small example?
It's a ratio, right? Loan to value. Like, how much is the bank lending compared to the purchase price?
There you go. Yep.
So,
what is your down payment amount, and what percent do you have invested into the home? Right.
Right. Okay. Yeah.
Okay.
So like $200K loan,
Mhm.
180 down.
Yep.
80% loan to value. Did I do that right?
No.
Okay. All right.
200K down.
Amber 1, Adam 0. Let's
$6,000 down payment.
Wait,
and that would be a 97% loan to value.
Oh yeah, what the hell?
Yeah.
20% of 200K is $20,000, $40,000, $60,000. No,
$40,000.
$40,000.
$40,000. Hey, you know what?
God.
It's early.
Oh no.
Maybe you just haven't had enough coffee today.
Yeah.
We're gonna give you
too much.
We'll give you the pass on that one.
All right.
I
got the acronym right.
You did. Yeah.
Okay.
I'm impressed.
Okay. All right. Let's try again.
Okay. What is DTI?
DTI, debt to income.
Perfect.
Ratio.
It is another one. Now, do you know basic caps of those ratios for like a conventional and FHA loan?
Oh, I think for FHA, you can sometimes push like 55%.
Yeah, I think that, we max out at 57. 55 is really like the max comfort loan or comfort zone for a lender, just in case like property taxes change or your homeowner's insurance premium changes. Those types of details.
Okay. And then on a conventional, you're like in the low 40s somewhere?
You are capped at 50. Okay. Now, I would probably say again, comfort zone 47%, just to kind of add in those escrow accounts and make sure that we're not going to be pushing boundaries.
Okay.
Right?
And just so we're clear, what we're saying is that's like the percentage of your available income that the bank will allow you to spend on a mortgage payment.
Yeah.
So essentially, if you've got, $4,000 in usable income, the bank will let you take out a mortgage where your payment is up to $2,000. Give or take.
Give or take.
Yeah.
Yeah. Okay. Awesome. All right. What is P&I?
P&I? Oh, wait, PNI?
Well, I mean, I'm not I. Are you P?
Are you saying PMI or P and I?
P and I.
P and I? Oh, principal and interest.
Perfect. What's PMI?
Private mortgage insurance.
There you go.
We like the first one better than the last one.
We absolutely do. Do you know what loan program has PMI?
Any loan program, this is a trick question. Anytime you don't put at least 20% down on your purchase, you're gonna pay mortgage insurance.
Absolutely. Now, I would say that the exception to that is going to be a VA loan. So if you are a veteran, if you've served in the military, you have a DD 214, there's a really good chance that you don't have to pay PMI in your monthly payment.
Nice. Yeah. I didn't know that.
Yeah.
Cool.
Absolutely. Okay. All right. What is MIP?
MIP? Malpractice insurance?
Hey, you can't tell me that I do that in any way, shape, or form.
MIP? I have never heard this one. What is that?
Okay, so it is slightly similar to PMI, okay, but it is essentially a government fee that they tie onto FHA loans. And so it's going to be a lump sum fee that gets wrapped into your total loan amount.
Mortgage insurance premium?
Mortgage insurance premium.
Okay. So
Yep.
like okay. All
Yep.
right. Yeah.
Yep,
So it's a
absolutely.
lump sum fee rather than a monthly payment?
Yes, and for FHA loans, you will have both. Okay, so you will have the monthly payment.
Right.
Then
Okay.
you have the lump sum fee that gets added to your loan amount. You do not pay this out in cash.
Got it.
Now, if you refinance into another FHA loan, there is a portion of that MIP fee that can get credited back to you based on how long that you've held the loan for.
Okay.
Now, if you sell the loan and then go and get a conventional loan, then at that point you're paying that fee in full.
So this is like a couple grand.
Yeah, it's about like a 1.75% of your purchase price. So I mean, if we're talking about lower dollar homes, then yeah, it comes out to a couple grand. But if we're pushing like $500,000 to $700,000 homes, it's a significant fee.
Yeah,
Yeah.
absolutely. And do they put it in the first or the second loan?
So they do put it in the first loan.
Okay, cool.
Yep.
So you're
Yep.
paying that lower interest on it.
Lower interest, absolutely. Okay, what is a VOE?
VOE, verification of employment.
Perfect. I'm
Yeah.
impressed that you knew that one.
That one's been fun sometimes because not every HR department is created equally.
Right. And, just depending on how they fill out those little boxes or if they write the wrong thing, an underwriter can absolutely, take the direction of an income calculation in a whole nother level than what you had previously anticipated.
Right. Yeah.
Yeah.
Your boss could inadvertently kill your purchase if they yeah.
Well, and I also think it's a really good idea to, if you are working with a loan officer, have the loan officer correct them, review them before submitting to an underwriter. So that way, if they do need any corrections, we can kind of work out those details.
Yeah.
Right.
Underwriters, we love underwriters. Underwriters are very important, but sometimes they are the villain.
They're like mini lawyers in the background waiting to kill the deal.
Yeah, exactly. Just making things hard.
Yeah, that's how it feels. They're really there to make sure that all the boxes are checked, all the T's and I's are dotted and crossed, and to make sure that you're not going into a bad situation and
that's just it.
Yeah.
Right.
Yeah.
If you can make it through underwriting, you're a lot more likely to be making a good decision, right? Because they're going to find any reason why you can't afford this house.
Right. And just ask for clarification. They just want to make sure that what they have on paper is actually true and correct. So
sure.
We like underwriters on good days.
Yeah.
Yeah.
On bad days, we like to, sometimes we get angry at underwriters, but they're just doing their job. All
right. Okay. What is CTC?
CTC, clear to close. That's our favorite.
That is our favorite.
That is our favorite word. We've been under contract for a month and a half, however long it takes. And you finally get that final clear to close. We're past inspection. We're past appraisal.
Yep.
That's the last thing that says, yes, we are closing. Like tomorrow.
You get to be a homeowner.
Yes.
Yeah. It is the best. It's a great feeling. Okay. What is EMD?
EMD. Oh, earnest money deposit.
There you go. That one's like,
I have to deal with that one.
The simplest one. Can you give me kind of like give me an understanding of what earnest money really is?
Yeah. So it's basically just protection for the contract. You put money in earnest, you deposit it with a neutral third party, such as a title company, and the title company just holds on to, $1,000, whatever it may be. And then when you go to close on the purchase, it just gets applied toward your down payment.
Perfect.
If you, basically break the terms of the contract, try to screw the seller over, they are entitled to take that earnest money.
Okay.
So it just protects the transaction. If we terminate for any valid reason, you just get it refunded.
There you go. Yeah, I love that.
Yeah.
It's kind of like what's your skin in the game?
Exactly.
Right?
Yeah. You're just putting a little bit of skin in the game. It's a big purchase, I mean, obviously if you're saying, hey, I'm going to buy this $300,000 property from you. I mean, that contract needs to be enforceable in some way.
And I would imagine that, I mean, if you're really looking at negotiation, let's just say that we're in the height of summer market, right? And we've got multiple bids on the same home. Can you answer for me if increasing that earnest money deposit would be valuable for your buyer?
Yeah. Sometimes that is one of the simplest ways to make an offer look more attractive, look more serious, right? Let's say you're in a bidding war and, you happen to be at the exact same offer price as another buyer. If you've got a $3,000 earnest money deposit and they've only got $1,000, chances are they're just going to go with you.
Yeah. Because
it's
if anything falls
aggressive.
through, they also might be entitled to a higher earnest money deposit check, right?
Yep.
But
absolutely.
Also it shows that, hey, you're responsible. You have your finances all squared away and you've got $3,000 to spend.
Yeah. So I'm glad you brought that up because that is one of the easiest little negotiating techniques to that I like to pull out of my pocket when we're in a bidding war.
I like that. Okay, what is a CMA?
CMA is the comparative market analysis. I should know that. I'm the one that runs these. So it's people think that like you need to get an appraisal to value your house. The problem with that, especially in Idaho, is that appraisers don't actually have access to sold data the way that realtors do.
Okay.
And so a realtor can run a comparative market analysis where we essentially look at like kind properties that have sold recently and give you a very, very accurate estimate of what your house is worth.
I'm actually really glad that you mentioned that they don't have access to old, like the sold values, right? Because as a lender, I notice that when we have a purchase and sale contract and we have a certain price point that we need to hit, a lot of appraisers do their best to hit that price point, even if it's an older home, maybe the uglier home, right? It's got some work to be done. But if I turn around and do a refinance on that property, usually my appraisal values come in a little bit low.
Yeah. If there's no contract there for them to see what the number is they need to hit, unfortunately, they're kind of shooting in the dark. So you could order an appraisal on your house and end up being really discouraged because they're going to give you a number that could be a lot lower than the actual value. And the same is true in reverse, right? The last thing you need is for an appraiser to tell you your house is worth this much, and then you call an agent and that this number that you're now excited about is completely unrealistic.
Okay, no, that's a great point. We're going to get into some like different loan programs. Okay, what is a DSCR loan?
DSCR loan, debt service coverage ratio.
Yes.
Loan. So essentially, rather than looking at the buyer's financials, we're looking at, will this property cash flow as an investment?
Yes. And it's actually really nice, especially for, I would say, self-employed individuals. We run into a lot of investors sometimes, or even first-time investors, and they've saved up this down payment. Maybe they already have their primary home. And since they already have their primary, every now and again, they're not going to continue to structure their tax returns with, high net profits every single year because they don't need it to qualify.
So we're not thinking about their DTI here. We're looking at this property as essentially a little business.
Yes. And so as a lender, whenever we do kind of price out these types of loans, an LLC can purchase this loan, a trust can purchase this loan, an individual can purchase a loan. If you have a down payment, we enroll you into the program. We take a look at how many units that you're purchasing. And then when we go to order the appraisal, not only for the value of the entire building, but the appraiser is going to give us it's going to be a document that essentially states that we estimate the monthly income for each unit to be X, Y, and Z. And as long as that monthly income covers the mortgage payment, typically you're going to have smooth sailing through a DSCR. Now, if for whatever reason, those estimated monthly payments for those units come in lower than the mortgage, there is still a way to get around it and still get your buyer pre-approved. Typically, it's just going to come with a little bit of a higher down payment. So if you've got an investor with cash and they know where they want to apply that cash for their next investment, let's go ahead and take a look at a DSCR. And that way you don't have to worry about your tax returns. You don't have to worry about your bank statements. It's all just nice and simple. What does this business of a property look like?
So guys, this has been another episode of Buy the Ugly House. Again, thank you, Amber, for stopping by. And if you guys have any mortgage related questions for Amber, drop them in the comments, or you can also find her on all of the social platforms. I'm sure we'll tag you. So yeah.
It was a pleasure. Thank you so much.
Thank you. Guys, sometimes it feels like I'm all alone in here. I know you guys are watching. I know you're getting value from it. But if you could just drop a comment and subscribe, just let me know that you're getting some value from this. I would appreciate it so much.